Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 26th of May. I'm Daniel Lam, your host for the podcast. We've spoken about how data watching is going to be even more pertinent than it had been, because the low-hanging fruit of trade de-escalation had more or less been priced into risky assets. Now, recent data has shown resilience. For example, the manufacturing flash PMI numbers have been reasonable, with US manufacturing and services jumping to 52.3. The manufacturing side is also doing quite well in Eurozone and Japan. Business sentiment indicators have also improved in Europe. So all these shows continued optimism on tariff relief. But because of the scale of recovery in risky assets that we've seen, that's already gone quite a bit. It will take more concrete and positive developments for risky assets to go higher from here. We need to see more trade deals getting concluded, and we also need to see resilience in hard data, i.e. the data related to real economic activities, in order to sustain market gains. At this moment in time, we need to search deeper for value. Last week, we concentrated upon equities. How about bonds? Well, current nominal bond yields are near the upper end of their recent range, making the risk-reward profile attractive, especially for high-quality bonds. And high-quality bonds can serve as a hedge against the prevailing uncertainties. But do take note that while nominal corporate and EM bond yields are higher, credit spreads, i.e. premium over government bond yields, is looking tight again after falling to their one-year average. So therefore, in the bond space, investors can focus upon DM government bonds. Yes, we understand that concerns about inflation and the US fiscal deficit have pushed yields higher. But we do expect yields to fall in both soft and hard landing scenarios. It is attractive for investors to add when US 10-year government bond yield is above the 4.25% level. Lastly, do not forget about reinvestment risk. Cash is susceptible to such, especially when soft landing comes and the Fed cuts rates. Locking in the current or higher level of yields in reasonably long duration bonds, i.e. those of 7 to 10 years, is something that investors should be considering. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.